everyone, think of MFRS 134, Interim Financial Reporting, as a progress report that companies issue during the year. For example, Sami Berhad must publish quarterly reports under Bursa Malaysia rules within 2 months after each quarter. The purpose is to give investor and creditor timely and useful information so they can regularly check the company's performance and financial position and cash flow, even though they are usually unaudited. MFRS 134 sets minimum content requirement. Whether full or condensed, company must include key statement like statement of financial position, profit or loss and other comprehensive income, change in equity and cash flow, together with the explanatory notes. Important heading, subtotal and earning per share must still be shown to keep the information clear and consistent. The standard follow the integral approach, meaning that each interim report is part of the full year result and use year-to-date figure. Company must apply the same accounting policy as annual report. Revenue is recognized when earned. Costs are only deferred if appropriate. Inventory are measured at the lower of cost and net realizable value, and estimate like utilization and provision are updated each period. Materiality is judged based on the interim period itself. Finally, company must include explanatory notes on change in policy, seasonal activities, estimated dividend segment, and major event like acquisition. If policy change, early reports must be restated under MFRS 108. Overall, MFRS 134 makes the financial report more frequent, clear and transparent, so shareholder can easily track how Sami Berhad is performing throughout the year without waiting for the annual report.
Part A, Question 2. Identify 2 significant events and transactions that affect an entity's financial position and performance since the end of the last annual reporting period. The first significant event is when there is a change in accounting policy, except when the change is brought about new standard. MFRS 134 requires that similar accounting policies to be applied to the entire financial year. The change will cause the restated financial statement of prior interim period of current year and comparative interim periods of prior financial years, which may restate the figures and impact the reported results. Another significant transaction is major asset acquisition and capital expenditure that will affect cash flow and assets.
This question, I refer to the interim financial report of Sami Berhad. The company prepared its interim financial statement on a quarterly basis. For the current interim period, the financial statement covers the 3 months ended 31st March 2025, and the comparative interim period is the corresponding quarter from the previous year, which is 3 months ended 31st March 2024. In addition, the report also presents year-to-date figures. The current year-to-date period covers the 3 months ended 31st March 2025, while the comparative year-to-date period covers the 3 months ended 31st March 2024. These periods are consistently disclosed in the statement of profit or loss and other comprehensive income, as well as in the accompanying notes to the interim financial report.
Next, I would like to explain the comparison for Sami Berhad. For the statement of financial position, the current interim balance is presented as at 31st December 2025, while the comparative figure is taken from the previous year end as at 31st December 2024. This is because the statement of financial position is normally compared with the most recent year-end position. For the statement of profit or loss, the current interim report covers the period from 1st January 2025 to 31st December 2025, while the comparative period is 1st January 2024 to 31st December 2024. Likewise, for the statement of comprehensive income, statement of changes in equity, and statement of cash flow, both current and comparative figures are prepared for the same respective annual period.
Part B, Question 1. Explain briefly on MFRS 8. MFRS 8 is about operating segments. So, what are operating segments? Operating segments is a component of an entity that engages in business activities that may earn revenues and incur expenses for the entity. Other than that, whose operating results are reviewed by the chief operating decision maker to make decisions about resources allocation and performance assessment, for which discrete financial information are available. So, what kind of entity are considered as operating segments? New segments, startup operation, that face all characteristics but has not yet received its first revenue may be considered as one, meanwhile HQ and retirement benefits plan are not considered as one.
I would like to explain the Chief Operating Decision Maker or CODM under Mfrs 8 operating segment. First, CODM is not a specific person or job title. It's referred to a function within the company. The first responsibility of CODM is performance assessment, where the CODM review the result of each business segment. The second responsibility is resource allocation, where the CODM decide how budget, manpower, and investment are distributed among segments. Although CODM is a function, it is usually carried out by top management, such as Chief Executive Officer, Chief Operating Officer, or Chief Financial Officer. For example, some members have identified CODM as a collective group function known as the Executive Committee. This committee, which includes the founder and group executive chairman, Treasury Dr. Jeffrey Chia, and the group CEO, Dr. Chung Song-kyung, make decisions together regarding the group diverse segment, such as property development, construction, and healthcare. Conversely, at QR Resource Berhad, the CODM function is more individual focused, centered on the executive chairman, Dr. Chia Sung-kwon, and the group managing director, Mr. Chia Sung-kwon. Together, they monitor performance and allocate resources across pillars like marine product and integrated livestock. An example of the resource allocation was strategic move into farming months, which successfully integrated their food production segment with the retail customer base.
Under MFRS 8, companies break down their operation into segments to make their financial performance easier to understand. There are two main types of operating segment. The first is the business segment, which focuses on what the company does. Different products or services that have their own risk and return. For example, QR Resource business separates its activity into areas like livestock farming, marine product, palm oil, and convenience store. It allows users to see which business generates the most revenue. The second is the geographical segment, which focuses on where the company operates. Revenue is reported by regions such as Malaysia, Indonesia, and Vietnam. It's helping users identify which location contribute the most. Overall, segment report give clear insight into both business activities and region performance. It's making it easier for users to make better decisions.
Now I'm going to discuss the benefit of segmental reporting under MFRS 8 using QR Resources Berhad as an example. Firstly, segmental reporting helps users better understand a company's performance by breaking it down into different business segments. In QR Resources Berhad, the segments include integrated livestock farming, marine products manufacturing, convenience store chain, and palm oil activities. And from this segmental report, users can see that integrated livestock farming segment contributes the highest revenue and profit, making it the key driver of the company's performance. This will help investors identify which segment is the most important and where future growth may come from. Secondly, segmental reporting also allows users to assess risk by showing the geographical areas in which the company operates. QR Resources Berhad operates in Malaysia, Indonesia, Vietnam, and other countries, with Malaysia contributing the largest share of revenue. This information helps users understand the company's exposure to different economic environments and whether it is dependent on a single market. In conclusion, segmental reporting helps improve transparency by providing detailed insight into both business performance and risk, helping users make better financial decisions.